Today we're going to talk about investment ideas for 2025. First, we're going to take a look at big picture asset classes, what to buy, and what to avoid. Then we're going to look at specific ideas in those asset classes. And last, we're going to talk about what has worked historically when the stock market cycle shifts. Here's the big picture on what to buy in 2025 and what to avoid. We're going to keep it simple as far as the asset classes go. You want to be in small caps. They're 33% cheaper than the S&P 500 and they give a better yield. You want to be in emerging markets, 52% cheaper than the S&P 500, 133% more yield. It's a back up the truck moment there. You want to be in international, the Europe, Australia, Far East, it's 44% cheaper in S&P 500, 166% more yield. You're over 3% dividend yield there. It's amazing. Value stocks, dividend payers, about a third cheaper than the S&P 500 on average. You're over 200% more yield than the S&P 500. Finally, leveraged loans. Great yield over inflation, over 8%. No interest rate risk here. I think there's still room to run in this asset class. This is a great long-term hold and an excellent place to get yield in your portfolio. What do you want to avoid? You want to avoid long-term treasuries. No inflation protection. We might see more inflation and you're not getting any inflation protection here. I have plenty of videos on the TLT ETF. I'd encourage you to watch those. High duration, no good if rates go up. Negative yield after you factor in inflation and taxes. This is a loser. I wouldn't be putting money here. Magnificent Seven. Now I know it's blasphemy to say anything bad about the Magnificent Seven. They're wonderful companies, but they're really expensive. So I wouldn't be putting any new money here, that's for sure. You're 63% market cap to GDP. They're 36% of the S&P 500. The PE ratio of the group is 51 times earnings. It's totally insane. It's getting to the point that it's ridiculous. The market cap of the group combined is over 18 trillion on a $29 trillion economy. This concentration of wealth is really getting absurd. So again, great companies. I think the growth opportunity there is becoming diminished, and I wouldn't be putting new money in the Magnificent Seven. Here's a summary table for the asset classes I'm recommending to buy so that we can make a simple comparison for valuation and yield against the S&P 500. The S&P 500 trades at 28 times earnings and a 1.15% yield. It's really expensive. The asset classes I'm recommending trade at a significantly lower price and a much higher yield. If we look at emerging markets, you're buying this asset class for less than 50% of the price of the S&P 500 and more than double the yield. It's a tremendous opportunity for investors who are patient. When we go down the list, you can see that value stocks, which trade at 20 times earnings, pay 3.65%. Much better yield than the S&P 500. And finally, leveraged loans are at an 8% plus interest rate. Excellent yield from the leveraged loan space. Here are some specific ideas for investments that you can buy to get exposure to these asset classes. I put the ticker symbols here to make it easy. It's almost all ETFs in one mutual fund. I'm not a big fan of mutual funds for equities in particular. I like ETFs better or individual stocks. In this case, we're looking at ETFs by Vanguard and BlackRock, and then we've got Vanguard and BlackRock for emerging markets, international, and for value stocks, there's a number of options out there, and I've listed some of the options that I think are better options. Schwab, high dividend, Spiders, high dividend yield, Vanguard, iShares, etc. They're all good, they're all liquid, they're all inexpensive, they have low expense ratios. For leveraged loans, Fidelity has an excellent leveraged loan fund, FIQSX. That's something else that you want to be taking a look at. Now you can lose money in every one of those ideas, so make sure that they fit with your risk tolerance, your asset allocation, and your financial plan. Be sure to discuss them with your financial advisor. But I think for investors who are patient and can commit to a 5 to 7 year hold or longer, you've got a great opportunity to make money on these investment ideas. Look, we all know that the stock market goes up 74 out of 100 years. So next year, what are the odds that you're going to make money just by buying the S&P 500? 74%. And if you hold For 3 years, your odds of making money in the S&P 500 are 85%. If you hold for 5 years, 88% odds of making money. It doesn't matter if we have a Republican or a Democrat as president, who's in the Senate, who's in the House. That stuff doesn't matter. The odds, you make money under all the above, right? But so the odds of making money in the stock market are good. But how can we improve going forward? How can you make more money? And I think that the ideas that I'm showing you give you an opportunity for outperformance in the years ahead. The S&P 500 is very expensive. We might make money on it, but I think the growth is going to slow down in a big way. Now let's take a look at how investments have traded on and off between growth and value in past economic cycles, because I think we are late stage in the current cycle, late stage bull market, and we're probably getting ready to shift from growth to value. The stock market has a very easy to identify long-term pattern. Bull markets, the green arrows eventually end and give way to bear markets, and then the cycle repeats. In 2025, here's where we are. We have a long-term bull market in place. How much longer is it going to continue? I think we're probably getting close to the end of this bull market. When the cycle flips, here's what happens. This is the 2000 to 2013 bear market in the S&P 500. No return on price for 13 years and 2 very serious drops along the way. Not a pretty picture, not a lot of fun. Let's take a look at what worked during this time period. Small caps provided return when the S&P 500 did not. If you had put $10,000 into small caps, the Russell 2000 on January 1 of 2000, by 2011, you had $16,000. If, on the other hand, you'd put your $10,000 in the S&P 500, by 2011, you still had $10,000. So no return, and this is total return, no return for over a decade on the S&P 500. It was a lost decade. A lot of volatility. However, small caps gave you 60% total return over the same time period. So if we do experience the cycle changing anytime soon, small caps are a good place to be putting your money. During the 2000 to 2011 time period, value stocks significantly outperformed growth stocks. If you had put $100,000 in the Russell 1000 Value Index, by late 2011, you had $137,000 plus. If you put $100,000 in the Russell 1000 Growth Index, which is equivalent to the Magnificent Seven today, by 2011, late 2011, you had $76,000 plus dollars. This is the total return for both illustrations, and it demonstrates the point that when we enter a recessionary period, when the stock market cycle shifts and growth slows down, you want to be in value stocks. If your financial advisor isn't discussing ideas like this with you, please give my office a call. We would be happy to give you a second opinion on your portfolio. So let's add it all up. The S&P 500 is very expensive. The Magnificent Seven stocks have reached a ridiculous amount of concentration, the most ever seen in the history of this country, more than 1929, more than 2000. Some of those companies are probably going to get broken up, much like Standard Oil was over a century ago, or AT&T in the 1980s. Would not surprise me to see Microsoft or Google get busted up into a number of companies. It's just what happens when a company gets that big. There are other opportunities for investment that provide better return potential in the future, my opinion. Small caps, international, emerging markets, value stocks, leveraged loans. Those are areas that you want to be looking at for returns going forward. Again, it doesn't mean you can't make money in the S&P 500. S&P 500 is a great index, but the huge influence from the Magnificent Seven, the very high valuation, and the likelihood that maybe a few of those Magnificent Seven stocks will get broken up. And again, that could go either way. It could be good or bad, depending how the chips fall on the table. I just think you're better off in some of these other asset classes. You have a much better return opportunity. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.